All right, this is Sellput Capital, and today in this video, we're going to talk about the Kelly Criterion, which is a criterion that was formulated to help inform decisions about what fraction of your portfolio or your bankroll to allocate to a particular bet or investment with some payoff structure. So in this video, we're going to go through a bit of the background, and go through a few examples of increasing complexity so you can build an intuition. All right, so in order for you to maximize the utility that you gain from this video, it's important that you understand some of the basic concepts underlying the criterion. So, if you've taken a calculus course or a probability theory course, you may have seen these concepts before, but for completeness, I'm gonna go through them here. So the first is, what a random variable is and how you find the expected value of such a random variable. So a random variable is a variable that can take on a certain set of outcomes, right? And it can be discrete or continuous. So a discrete random variable has a finite set of outcomes. So, a coin flip has two. So you can get either heads or tails. And you can map those results to numbers. So, the head can map to 1, the tails can map to 0 or -1. And in this particular example, I'm going to map it to -1. And then, if you throw a die, it can land on any of the 6 sides, and you can map every side to a number from 1 to 6. A continuous random variable is different from a discrete random variable because it can take an infinite number of, or rather, it has an infinite sort of range of possible outcomes. So for the Gaussian random variable, it can be any number, any real number, right, from -infinity to infinity. And if you think about, say, if you imagine a scenario where you pick any random rock in the universe, the mass the mass of that rock will be distributed on 0 to infinity because there are no rocks with negative mass. And each of these random variables has some probability distribution function. For the discrete case, we call it a probability mass function because you have a chunk of mass allocated to each outcome. So for a fair coin, for example, you have a probability of 1/2 of getting either side. For the die, it's a sixth of any side. But for the continuous random variable, instead of mapping, instead of calling it a mass function, we call it a density function because there's an infinite number of outcomes, and we want to know how dense sort of the probability mass is in a particular neighborhood of points. So for the Gaussian, it actually looks something like this with an exponential with a quadratic term. And for the weight of a rock, you can imagine that it's some curve going from the mass of a few atoms of your choice all the way up to, say, the mass of a galaxy, right? Somewhere in there. So yeah. Now these random variables can they have outcomes. They have the probabilities associated with those outcomes, and you can also find what the expected value of these outcomes are. Right. So in the discrete case, what you do is you take the outcomes, right, which here I call x, and the probabilities associated with them. You multiply all of them together, and then you sum them. Right. That's what this capital sigma is. So, for example, for the coin toss, right, we have some probability of getting heads, which for the fair coin is 1/2. Some probability of getting tails. We multiply each of these results, right? So the heads with 1, the tails with -1. And we get 1/2 and -1/2, and then we take the sum. So we add these two together and we get 0. So a fair coin has no edge. Similarly for the die, right? We just do a sixth for each one of the outcomes, right? So it'd be a 6 times 1, a sixth times 2, a sixth times 3, and so on. And what we get is 3.5, which is precisely the average of all the outcomes because every outcome is equally likely. Now, for the continuous case, conceptually, it's a similar process, right? So this integral is a sum of an infinite number of an infinitesimally small number of things. So it's the same sort of process. And this operator here is sort of finding the area under a curve, right? So the way you do it is you take the probability density. So here's our bell curve. We take the outcomes, right? We multiply them and we get this, right? So 0 times a number maps to 0, so there it is, right? And then the right side is positive, but then it sort of decays because of the bell curve. And on the left, right, the outcomes are negative, and so the product of this is negative, and then it decays again. And then, up here we had some sort of symmetry, all right, which is what led to the case of zero edge. And it's the same here, right? For every column of probability mass here, there's an equal one going the opposite way, and so this symmetry sort of cancels out in a way that converges neatly, and that's how we get that the standard normal has a mean of 0. So that's this procedure here is what you should take away from this slide, which is this is sort of the definition of the expectation value of a random variable. There's one final concept that we have to go through before we can, immediately use all these concepts in discussing the Kelly Criterion, which is the process of optimization and the concept of derivatives. So optimization refers to the process of having some function. So for us, that'll be, expected long-term wealth that has one or more parameters or variables. And the process is finding the value of those parameters that maximizes or minimizes the function, right? So again, for us, we're going to try to maximize wealth. And so if you have a function, right, any curve like this, it can have local maximum, which is sort of saying, if you pick, any arbitrarily small neighborhood of points, we want the maximum of such, of that, right? But however, right, there could be a global maximum elsewhere, right? And so that's the one we're interested in. And then, similarly, you can have local and global minimum. Now, relatedly, right, at these points, at these extrema, there's exactly and precisely one line that you can draw that touches exactly that optimal point, and it'll have a slope of 0, right? So you can see how I could draw a line here, right? Just as it's drawn here. And so we want to find basically the point where, the slope of this line is 0. And so that's where we sort of introduce this concept of a derivative. So if you haven't taken a calculus, this is the symbol that denotes the derivative of f with respect to x, which when you evaluate it at x gives the slope of the function at x. So for this parabola, which is f of x equals x squared, I won't teach you the calculus, but you can Google it and you'll get that the derivative of x squared is 2x. So if you want to find a point that has a slope of 0, right, we can see that if we set x equal to 0, we'll get that, that the slope is 0. And so from here we can conclude, right, making an assumption about the curvature of the function, that this point has an extreme point at 0. So so that's how we find this point. So now that we have all these concepts, we can finally talk about the Kelly Criterion. So if I encounter some bet with some odds or some profile of possible multiple on invested capital, or the net odds x here, I want to bet the fraction of my wealth, the fraction of my bankroll that will maximize my long-term expected wealth. So suppose I take this identical bet, many, many times, and I end up with some set of x1, x2, x3, x4, which is the result of every game, right? So for every single game I got some return, right? So these are the net odds I received. And I took this bet many times, each with the same fraction of my bankroll f, of my new bankroll every time, right? So what this means is that I started off with some wealth, W0, or W0, and I multiplied it by the result of the first game, right? So now I have some new wealth, W1, which is this longer expression, and then I play the game again, and I got some result, and now I have wealth W2, and then I play the game again, so now so I multiply by this factor. and I have wealth W3, and so on. And what we're left with is a chain of these multiplication, factors. Now, we can use some algebra and this property of the logarithm to change this series of multiplication into this series of addition, right? So we still have this factor W naught, but then we use the fact that we can take these two factors A, B and write it in this way to get, that it's that the long-term expected wealth Wn, which is the wealth after n games, is W naught times this exponential plus a sum now of all these logarithms. Now, because, we're playing the same game every time, and because each game is independent from each other, that is to say that all these samples came from the same distribution for this same random variable, we can use the law of large numbers to approximate this sum, right? And so this sum will be approximately equal to n times the expected value of this factor. And so, we can write our long-term expected wealth, assuming n is large enough, in this way. So it'll be our initial wealth times the exponential factor of, all of the, of the expected value of the result of the game. So this is the thing we want to maximize, right? This is the thing we want to optimize. Now let's look at the parameters, right? We have W naught. But W naught is unchangeable, right? We're already at the casino. We're already at the table. In the real world, you could get a job and, increase your initial wealth, before you go out and play a game. But, in this particular scenario, we're not going to do that. And in addition, if the game has positive edge, we can play more games to try to, get more wealth. But at the end of the day, we want to maximize our wealth for a fixed n, right? So we're going to play n games, and then we want to maximize our wealth after that, or, at the end of those n games. So to maximize the final wealth Wn, the only thing we need to worry about is here, right? This log 1 plus fx. And the only free parameter, the only free knob is f, right? So we have to find and tune this f until we find the optimal f that gives the maximum possible value for this expectation. That is what the Kelly criterion is. So let's do an example. So we have a simple 2-outcome bet. It can be a coin flip, say, right? So we have some wager. So we'll do an example, right? So $10. So this will be some fraction of our bankroll, but just we have some wager. And there are two outcomes. One is we lose our wager, right? So we get a 0x multiple, right? And the second is that we 5x our money. So we can either 0x our money or 5x our money. Now, in terms of the language of these x's here, which are the net odds, right? We lost 100% of our wagers. This would be -1. And in this particular case, right, we got a 400% gain for this payout. So we received our initial wager and then gained 400% in addition to our our initial wager. So these are the values of x. And for now, I wrote p here, but let's assume p is a half for this example, right? So the thing again we want to maximize is this factor, because maximizing this will result in maximizing long-term expected wealth. So, we take this formula here that we did before, similarly with the coin flip. But now instead of we're taking x, right, we're taking the expectation value of this thing. So what we do is we do p, which is the probability of this first result, times, right, this first outcome. Then we add the rest of the probability, all right, which is 1 minus p, times the result of the second outcome. So we want to sort of optimize with respect to f, right? So we take this derivative. Now again, if you don't know any calculus, you can use Wolfram Alpha at wolframalpha.com to take this derivative for you, or some similar type of resource. But for the purposes of making this video a little bit shorter, I'm just gonna give you what the derivative is. So this is what the slope is, after plugging in all these values. Now, we want to find where the slope is 0, right? Because that will be an optimal point. And it turns out that it'll be the global maximum. Now, again, to save some time, I'm going to use Mathematica now here to solve for what f would be. So I'm just going to skip all the algebra. And this is the expression we get. Now, if I factor out this minus sign, which means that I get to flip all the signs of these, I can group this, right? And this top factor here, this numerator, is precisely what we would call the edge of x1, right? But the bottom doesn't look like the usual winning payout that we see in the classic Kelly Criterion formula. Now that's because the Kelly Criterion formula was derived for a situation where you have such a simple bet, where you have, like in this particular example, a 0x payout. And so when we actually plug in x1 equals minus 1, right, we get this edge on top, right? I just move this to the front, and then we get a minus sign here, and this x1 turns to minus 1, which cancels out this negative, and so we're left with this. Now this is precisely the original formula, edge divided by winning payout, right? Which is what you get when you win. And when we plug in all these values for the value p equals 1/2, we get that the Kelly Criterion recommends that we bet 37.5% of our portfolio to this wager. I mean, and we can just look at it and see that that would be a pretty good idea, right? Because you could either 0x or 5x your money with equal chance. So, I mean, of course, such a criterion should tell you to bet pretty big. But, now the question is, how do you generalize this to many outcomes or more complex bets, right? But so the thing to keep in mind is, if you boil it down, right, this is what the Kelly criterion is, right? We just want to find the optimal f that maximizes this expectation. But with more complicated scenarios, it can be a little trickier to calculate, and sometimes you can't do it exactly, and you have to do it with a computer. So, I'm going to show you such examples. So one way to compute expectation values in general, not just in this particular context, is with Monte Carlo simulations, right? So if you take a coin and you flip it 10,000 times, you expect to get 50% heads and 50% tails approximately, right? And so if you do the same thing where you map heads to 1 and tails to -1, right, you can estimate the expectation value of this random variable x, which can be 1 or -1, by taking by adding up all of your 1s and -1s that you get from flipping your coin and dividing by 10,000s, right? So this is the average, right? And you should get something that's very close to 0 after doing something like this, right? Because the fair coin is fair. And so we can use the same methodology to estimate the expectation value of our log 1 plus fx for something like a stock, right? So if I have a business that I'm trying to forecast the revenue, the earnings of and the fundamentals of, I can come up with, say, upper bounds and lower bounds for the revenue growth, the gross margin, the operating expenses, etc., and then do some discounted cash flow and come up with valuations that are within those parameters that I specify. And I'll get this distribution for V, which is the valuation, right? So this is just a fake business. This is a million simulations of some business. And we can see that the business, right, or that for the parameters I gave, right, this fake business should be valued somewhere between 25 million and 65 million, right? And we can see that there's a rightward skew, right? So, the tail falls off at 30, similarly to how it does at 60, but the mode is not at the midpoint, which would be 45, right? So there's a rightward skew. But in any case, right, I can take all these 1 million valuations that I got, right, and I can come up with what the odds are given the current price of the business, And I can do the same procedure that I did for the coin flip, and try different values of f. All right, so here it is, until I find, and then try to find the optimal f. Right. So for this particular business, the Kelly Criterion tells me that I should bet 70% of my portfolio, which is a lot, and we'll talk about some of the limitations of the criterion and some things to consider on the next slide. But for quarter Kelly, which is just a fourth of this, it tells me that I should bet 17, almost 18% of my portfolio to this business. So some things to keep in mind, right, and when you're actually using this, is the optimal f that is given by the Kelly criterion can change drastically based on your assumptions, right? So if I were to lower the lower bound for the gross margin in my Monte Carlo simulations, right, the quarter Kelly might go down to 10 or 5% or 3% or 2% or whatever it is, right? And so because it's not super stable, right, it can vary a bit. People, that's precisely the reason why people adopt half Kelly or quarter Kelly, right? So this is a way to sort of hedge against your ignorance or hedge against scenarios that you didn't imagine could happen. So that's something to keep in mind. Now, also, notice that in this particular example, right, none of the samples, in this histogram, or rather, none of the million samples, none of the million simulations resulted in a valuation of 0, right? So I did not include the possibility of bankruptcy, right? And so the most I could lose according to this sort of distribution, right, is 42 to 25. So let's say the most I could lose is about 50%, right? So there is no possibility for total loss of capital according to this histogram. Now, when you have a payout structure that looks like that, the optimal f can be greater than 1. So that is to say, the Kelly criterion could recommend that you lever up and bet more than what you have in your portfolio, based on to one particular idea. Now this is a feature, not a bug, and it's perfectly fine for very rigidly structured bets, like say you're playing a game, with very firm rules, like I don't know, chess or poker, and if you're best 3 out of 5, you get a very exact amount of money, right? But it can be very dangerous in scenarios like in the stock market where you can't be certain of the payout profile, right? So in this particular case, I did not allow for the possibility of bankruptcy, which is why the recommendation was so high. And it can be even more dangerous, like when you're selling like a naked call, say on GameStop, and you can lose actually a lot more than your wager. Right? So that's just one thing to keep in mind, is always be sure to include, or be mindful at least, of the true actual possible total risk. Secondly, right, the Kelly criterion, when we boiled it down, was the optimization of this expectation value, which maximized our long-term wealth. But it did not take into account anything about variance, right? And so what can happen is, if you do bet full Kelly, you can suffer from very large drawdowns, and that's something to be mindful of, because from a psychological perspective, a lot of people can't handle very large drawdowns, right? So if you're 50 with several million in your bankroll, to take an 80% loss is just absolutely unacceptable, right? Because that's your entire life savings. So that's yet another reason to never go full Kelly. Right. And so in scenarios like this, where I include a payout that does not allow for the total loss of capital. I personally sometimes even go a lot less than quarter Kelly, sometimes a tenth or a 20th, of the full Kelly. Yeah, but I take into but so one thing to keep in mind though is if the Kelly criterion produces an F that is large, assuming that you included all possible outcomes or almost all possible outcomes in a reasonable and conservative way, if it produced that large of an F, I take that to be an indicator that you have a good bet, to take. So the larger the F, the better the bet is. But you have to make sure that you're very honest and very conservative in the range of possible payout scenarios and the probabilities that you assign to those payouts. And finally, right, so we use the law of large numbers to come up with this approximation for the final wealth, right, after end games. And so it's important to keep in mind that, if you're going to use this in investing or even, in a gambling scenario, you're probably not going to play, or invest in 1 million or 1 billion businesses in your time, in your, over your lifetime. So, this approximation can sort of break down, especially if you run a portfolio with a very low turnover. So if you were to go full Kelly, you could suffer from a large drawdown and then not have enough other trials to recover from that drawdown. So again, this is yet another reason to never go full Kelly. But it's still an interesting concept, and that sort of concludes my thoughts on the Kelly Criterion. Thanks for watching.